Most people go through life staring at the puppets. They watch the stock market, obsess over the price of Bitcoin, and count the cash in their wallets. They think they are looking at money. They are wrong. They are looking at the symptoms. The disease, the cure, the power, and the foundation of the entire global civilization lie beneath the surface, hidden in plain sight. It is the bond market. To understand why, we have to travel back in time, not to a bank, but to a battlefield. Imagine it is the year 1694. King William III of England is in a desperate situation. He is fighting a massive, expensive war against France, and he is losing. Not because his soldiers are weak, but because he is broke. In the past, kings would just seize gold or tax peasants until they starved. But William needs more gold than exists in the vaults. He needs to pull money from the future. He makes a deal. A group of wealthy merchants offers him 1.2 million pounds in gold. In exchange, the king gives them a piece of paper. This paper is a promise. It says that the king will pay them back with interest, funded by taxes on ships and beer. This moment changed the human species forever. It was the birth of the Bank of England and the modern government bond. Suddenly, the king did not need to have money to spend. He only needed the credibility that he would pay it back. England went on to build the largest empire history had ever seen. They did not build it with gold, they built it with bonds. They outspent their enemies because they understood that debt, when structured correctly, is not a burden, it is a weapon. But here is the twist that most people miss. That piece of paper the king gave the merchants, it became more valuable than the gold itself. You could trade the paper. You could use the paper as collateral to buy land. The debt became money. This is the first lesson you must learn. In our modern world, money is not a physical commodity. Money is debt. Every dollar in your pocket is a note of debt from the Federal Reserve. Every euro is a debt of the ECB. If you do not understand the debt, you do not understand the asset. They are two sides of the same coin. Fast forward to today. The bond market is no longer a deal between a king and a few merchants. It is a roughly $130 trillion ocean that dwarfs the stock market. It is the most powerful force in the financial universe. Think of the financial world as a solar system. Stocks, real estate, crypto, and corporate earnings are planets spinning around. They are volatile. They change. But the sun in the center, the thing that holds them all in orbit and dictates how fast they spin, is the bond market, specifically the US Treasury bond. Here is how the story of value actually works. Investors are constantly asking one question: what is the price of safety? If I lend my money to the United States government for 10 years, what will they pay me? This is called the yield. The yield on the 10-year Treasury note is the most important number on Earth. It is the risk-free rate. It is the force of gravity for all other assets. Imagine the yield is 1%. That means safety pays almost nothing. So money flows away from safety. It flows into risky things. Investors buy stocks, they buy houses, they buy startups. The price of everything goes up because the gravity is weak. This creates bubbles. Everyone feels rich. Now, imagine the story changes. The bond market gets scared. Maybe they fear inflation. Maybe they simply demand a higher return. The yield shoots up to 5%. Suddenly, gravity increases fivefold. Why would you risk your money in the stock market for a 7% return when the government guarantees you 5%? You wouldn't. Money gets sucked out of stocks. It gets sucked out of real estate. Liquidity dries up. Asset prices crash. This is why the bond market is the ultimate truth teller. Stock market investors are optimists. They dream of the future. Bond market investors are pessimists. They do the math. When the bond market moves, it is not a suggestion. It is a command. There is a famous story from the 1990s involving James Carville, a political strategist for Bill Clinton. He famously said that he used to think if there was reincarnation, he wanted to come back as the president or the pope. But now he wants to come back as the bond market. Because, he said, you can intimidate everybody. This is Act 3 of our story, the conflict between the politicians and the market. Politicians live in a world of promises. They promise free healthcare, better roads, strong militaries, and lower taxes. To do this, they need to borrow. They issue bonds. For a long time, the bond market might sleep. It buys the debt, it nods along. But the bond market has a breaking point. These are the bond vigilantes. When a government borrows too much or when they print too much money to pay off their old debts, the bond market wakes up. It looks at the government and says, I don't trust you anymore. And when the bond market stops trusting you, it sells your bonds. When everyone sells the bonds, the price of the bond crashes. When the price goes down, the yield goes up. Remember the gravity? The interest rates for the government skyrocket. Suddenly, the country cannot afford to pay the interest on its credit card. We saw this in history repeatedly. We saw it in Greece. We saw it recently in the UK, where a prime minister announced a budget plan that the bond market hated. The market revolted, yields spiked, the currency collapsed. The prime minister was gone within weeks. The voters did not remove her. The parliament did not remove her. The bond market fired her. This is the terrifying reality of modern economics. Sovereignty is an illusion. A country is only as sovereign as its bond market allows it to be. If you lose the confidence of the bondholders, your currency becomes worthless paper. Now, we arrive at the part of the story that affects you directly, the money in your bank account. You might look at your savings and think you are safe. You have $10,000. It stays $10,000. But the bond market is telling a different story about what that money is actually worth. When the government needs to pay back those bonds we talked about in Act 1, and they don't have the tax revenue to do it, they have a choice. They can default, which means telling the world they are bankrupt. Or they can print new money to buy their own bonds. They almost always choose to print. This is called yield curve control or quantitative easing. It's a fancy way of saying they are debasing the currency to keep the bond market from exploding. This is where the story turns into a tragedy for the saver. When they print money to suppress bond yields, they are stealing value from your savings. The numbers in your account stay the same, but the purchasing power bleeds out. This is inflation. Inflation is not just prices going up. Inflation is the government defaulting on its bonds in slow motion. If you do not understand bonds, you view inflation as an accident. You think it is just corporate greed or supply chain issues. But if you understand bonds, you see the mechanism. You see that the government had too much debt. The interest payments were becoming impossible. So they sacrificed the value of the currency to save the bond market. They transferred wealth from you, the saver, to them, the borrower. So, how does this story end, and why must you watch the bonds? Right now, the bond market is flashing signals that haven't been seen in decades. We have something called an inverted yield curve. Normally, if you lend money for 10 years, you get paid more than if you lend it for 2 years. That makes sense. More time means more risk. But right now, the short term pays more than the long term. The bond market is twisting itself into a knot. It is screaming that something is broken. It is predicting a recession. It is predicting that the current system of debt is unsustainable. The stock market might be partying. The politicians might be smiling on TV, but the bond guys, the guys in the gray suits doing the math, they are looking for the exit. If you ignore them, you are flying blind. You are walking into a storm without an umbrella. Understanding bonds gives you X-ray vision. You stop looking at the price of a stock and start looking at the cost of capital. You stop listening to what the central bank says and you watch what the yield curve does. Money is not a store of value. It is a claim on debt, and the bond market determines the quality of that debt. If the bond market breaks, the money breaks. So the next time you hear about Treasury yields on the news and reach for the remote to change the channel because it sounds boring, stop. Turn the volume up, because that isn't just financial jargon. That is the sound of the engine that keeps the world turning. And you need to know if the engine is about to stall. We started the story of the king in 1694. We end it with you today. The world is built on promises. That is all a bond is. A promise to pay. A promise that the future will be more productive than the past. But promises can be broken. The person who understands stocks understands profit. The person who understands crypto understands hope. But the person who understands bonds, they understand reality. Don't be the person staring at the puppets. Be the person watching the strings. Because in the game of money, the bond market always moves first. And by the time you see it in the headlines, it is already too late. Are you watching the yields, or are you just watching the noise? Now you know the difference.